Hello, everyone. It's Monday, December 5th. Let's debrief on these markets. Nice rally into the close on Friday. Today, we do the opposite. We sell off through the course of the day. A lot of damage with defensive sectors at the top of the list. Ladies and gentlemen, this is the final bar. Hello, everyone. Welcome to the Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in a snowy Redmond, Washington. Thanks for joining us every weekday after the close as we break down the activity in the markets using the power of StockCharts. The technical toolkit is designed to help us navigate the markets in uncertain times by focusing on the message of price, breadth, sentiment, trend, momentum. We can try to understand investor psychology, learn the lessons of market history, and focus on where we should place our bets based on our knowledge of all of the above. Let's talk about what happened through the course of the day today, and really continuing on what we talked about last week. A lot of my conversations with guests last week talked about sort of this push and pull between the rally phase off of the October lows, but defensive sectors leading. And talking with Julius DeKempener last week, we focused on the improvement in cyclicals and some of the defensive sectors, which is a little concerning. Utilities at the top of the list, for example, on today. We'll look at all those charts here in a few moments. Did want to let you know about the upcoming schedule this week. We have 3 really good guests lined up for you. On Tuesday, the 6th, tomorrow, we have John Kosar from Asbury Research. He has a brilliant macro model called the Asbury 6. Very interested to see what it is telling us as we are in the seasonally strongest part of the year here. On Wednesday, Leslie Juflas is going to be joining us on the show once again. And then on Thursday, the 8th, Frank Capillari. Frank recently launched his own firm called Cap Thesis. He's a fantastic technical analyst and strategist. We'll get his take on what to think about between now and year end. Let's continue on our show today with the market recap. As you know, on Mondays, we have 3 parts to the show. We start big picture, starting macro, and then we go through sector rotation, then we finish micro. We talk about individual stocks and themes, names on the move that you should be aware of. So let's start with the big picture. As I mentioned in the introduction, quite a bit of deterioration through the course of the day today. The S&P actually closing below 4,000, which could be notable. Breaking back above 4,000 was one of those exclamation points on this rally phase coming off the October lows. We're now back below 4,000. So not only has the 200-day moving average repelled this recent advance, now we're pulling back and breaking down to a 3 handle on the S&P 500. That's down 1.8% from yesterday, or from Friday's close, that is. The NASDAQ composite underperforming a bit, down about 1.9% today. Mid-caps and small caps both down quite a bit more. The small cap index leading the way lower. The S&P 600 was down almost 3% today. Now, the VIX is moving back higher, and that was one of the interesting things we talked about through the course of the week. Last week, particularly on Thursday, when we dug into some of the sentiment data, we noted the fact that the VIX had gone below 20. And if you look back through the year 2022, every time the VIX has dipped below 20, we have very quickly moved right back above and had the S&P, having rallied into that lowering of volatility, quickly sold off. And so it's interesting that we're seeing a sell-off now so far today with the VIX rallying off of that 20 level. Could be a tease of what's to come through the remainder of this week. We'll see. Of course, this is setting up for the Fed meeting next week. Looking at interest rates moving higher through the course of the day today. Again, just a real difference from Friday's session to Monday's session. Friday, we saw rates coming down as bonds were rallying in a pretty big way, along with stocks and other risk assets. Today, we get the opposite. We get the dollar moving higher with the UUP up about 0.8%. We see bonds selling off, which pushes interest rates higher. So the 10-year yield back up to around 3.6%. Again, nowhere near the levels we saw, a couple months ago, up in above 4%, up about 4.25% at its peak here for the cycle, but certainly moving back in that direction. Finally, commodities all in the red. Natural gas prices took quite a hit today. Crude oil prices as well. Energy was the worst performing sector out of the S&P. Gold and silver down as well. So if you're looking for gold to be that safe haven, didn't feel like it today. Just like the S&P is testing its 200-day moving average, pulling back. We'll look at the chart of gold here in a few minutes. You'll see very similar pattern there. So the 200-day moving average, just a brutal barometer for some of these prices to eclipse, to change the course of their trends. Finally, cryptocurrencies, a bit of mixed results. Overall, though, the big ones in the red, Bitcoin and Ethereum took a dip lower during the equity trading session. That's what you see here on the right side. This is going back on Sunday into Monday, and you can see this roll off as the equity markets were open. Bitcoin currently down about 1%, just below 17,000. Yet again, Ether just above 1250. Let's continue on looking at the major markets. Just as a reminder, our market trend model, no change on Friday. We update this model every Friday at the close. Remains short-term bullish, medium-term bullish, long-term bearish. With my market misbehavior premium members, we go into a little more detail on that. But generally speaking, no significant change from what we saw last week. Now, the daily chart of the S&P really sort of encapsulates all the challenges that we've seen here. Now, I've been labeling this a bear market rally. I've taken a decent amount of heat for doing so because I've been told I'm not, paying attention to clear signals that the market's in a rally phase. And to be clear, I think of the market in different timeframes, and I've been very 100% transparent that in the short term and now the medium term, the trend has absolutely been positive. There's no denying the strength out of the lows. And when the S&P is up 10, 15, 20% off of a low, that has meaning. And one of the clear indications of that reversal into the October low was the bullish momentum divergence, right? We saw the lower lows September into October. Look at the higher lows in momentum. So the market goes lower, but the negative momentum is dissipating. That actually suggests an exhaustion of selling pressure or an influx of buyers that are willing to, stem the downside move a little bit. You can see the demand came in, and certainly we've moved quite a bit higher from there. But then the question is, what's next? And I think the concern I have on this market here is that we have hit what I call a confluence of resistance. And while this last week has seen the market sort of play with the 200-day moving average, play with trendline resistance, it really happened a couple weeks ago, right? In mid-November, we first hit that 4,000 level. That was that first major objective on the upside after 3,800, which is sort of a short-term upside level of resistance. From there, 4,000, a really big one. That's a Fibonacci level from a number of different frameworks looking at 2022. And you can see it in the blue shaded here, that area here. That blue shaded area also includes the 200-day moving average. And we broke above there. That was Wednesday's session last week. We had this big rally closing above the 200-day for the first time since April. However, that was it, right? We never closed higher than that day. And that's a sign of trend exhaustion when you see the market move higher. And then that's it. That's the high water mark, right? You make a break above a key level of resistance, but then we stall, right? We have no further upside potential. Where we got to on an intraday basis is right to 4,100. And again, that hits the trend line using the 2022 highs, January, March, August. We connect those highs with a big trend line. You can see that lines up really well with 4,100. And so not surprising to see a pullback from that trend line resistance. And I would continue the thesis that we talked about last week. Overall, I see this as a bear market rally phase until we would get above 4,100. When that happens, I will have to label this definitely. I think that immediately opens the door to 4,300, 4,325, which would basically be the August peak as an upside objective going into year end. But we have to get above that final level of resistance. As I was looking at charts over the weekend, I couldn't help but notice how the RSI, the momentum for the S&P 500, has certainly stalled out around this level, around 60. And that's really more characteristic of a bear market phase than a bull market phase. Just briefly here to finish off our big picture discussion of the market analysis, I did want to point out a couple charts here. Bitcoin would be one I'd want to go at. I was interviewed last week on a media outlet talking about Bitcoin. And my general thesis or my general comments to them were, this is a chart in a downward phase, right? And you've seen some support come in just below 16,000. That's where we first reached here in the second week in November. We retested that same level a number of times. That's just below the 16,000 level here. And we bounced up last week, right? We sort of rallied a little bit. And the question was, all right, is that the beginning of the recovery? And my comments were, I don't see enough of that yet. And what you really need to see is a higher low. You made a bit of one here about a week and a half ago, but not enough, right? You want to see the market rallying, and then the pullbacks are shallower, right? They don't sort of retest that 16,000 level. Until then, I still see this as a chart in a downtrend. The problem for Bitcoin is if you look further left to the chart, if we bring in more data, there's not much below there in terms of support. So you get down to like 12,000, 10,000 even. Those are the downside objectives that make sense with an asset class clearly in a downtrend. Finally, I mentioned gold, and I just want to show you briefly the chart of the GLD. We've highlighted how this is a chart that's rotated from a bearish phase to arguably more of a bullish phase, and we've seen that because the rallies off the lows. The new swing high, impressive. All of that is certainly encouraging. The momentum getting back into the bullish range, right? The RSI getting up to 70. That's all encouraging. Here's a problem, though. It hit the 200-day moving average last week and now pulling back. That's also a Fibonacci resistance level around 38.2%, which we pulled back from. That's also the high from August. So the S&P's configuration a little different. For the GLD, it's all right around this same level, a cluster right around sort of 160, we'll call it 167 to 168. Until we get above there, gold's actually giving signs that it's hit that exhaustion point in the uptrend. So interesting that a lot of these macro charts are sort of at an inflection point. They're at a point where if they would dramatically come back from here, I think, or pull down from here, I think looking back, we would see some clear signs of exhaustion. Breaking out above these levels, all bets are off, and I think it reinitiates a bullish phase. Haven't seen that follow through just yet. Continuing on with our next segment, the sector setups. We talked about the big picture, the S&P rallying into resistance, now pulling back through the course of the day. Today, as we sort of prepare for next week's Fed meeting, we talk about the exhaustion points potentially in gold. Let's talk about sectors. Today, just as an example, we had utilities, healthcare, consumer staples as the top three. Now, in general, I would describe those as defensive sectors, particularly utilities and consumer staples. Healthcare is kind of a mix, right? It has some offense and some defense kind of mixed in there. It's kind of a different one, but the utility sector, the best performer, still down 0.6%. The worst performers today, energy down about 3%, consumer discretionary down 2.9%, financials down 2.5%. So if you look at it, you can see that overall, all 11 sectors to the downside. But let's take a step back and sort of see how these sectors have been rotating. We'll go to the RRG for this. And if you missed my interview last week with Julius de Kempener, I think that was Thursday show, Wednesday or Thursday. I believe it was Thursday. Julius did a great job sort of talking about this particular rotation. We talked about some of the influx of momentum for cyclical sectors like industrials and materials, and defensive sectors, things like consumer staples. This is using weekly data on the relative rotation graph, and you can see in general, sectors rotate in a clockwise direction around the benchmark, which is sort of the crosshairs in the middle. Heading northeast, I call the direction of improvement. That's good, or direction of appreciation. That means that the sector is outperforming and the momentum is increasing. Something heading southwest is what I'd call the direction of deterioration. That means weakening relative strength and weakening momentum. Opportunities often lie when something's been underperforming and rotates back in the northeast direction. And ideally, that all happens to the right of the y-axis, because what that means is that the sector continues to outperform because it's further to the right of the y-axis, but it just sort of does this little cyclical circular rotation to the right side. What that means is just the momentum is sort of coming in and out, but overall the trend still remains strong on a relative basis. That's kind of what consumer staples have done recently, which I'm noticing here. You see consumer staples now heading north. If we rewind a little bit, you could see staples were back down here. See if I can actually work the StockCharts platform. There we go. Here's consumer staples. I've kind of bold-faced it. You can see it was down here in the weakening quadrant. This is back going into the August peak. Then look at what's happened since then. You see how it's a rotated northeast, now back in the leading quadrant and heading in the correct direction. So that's actually a sector that's showing some improvement. It's interesting to see some of the charts that have not really broken down in that sector and now starting to improve a little bit. Other sectors that are showing improvement, probably not surprising if you've been following the show or really following the data on StockCharts, industrials and materials. We've talked about the improvement in areas like gold stocks, which have been chronic underperformers in 2022. In the last 6 weeks or so, really starting to come in their own. In industrials as well, we've highlighted things like defense like Raytheon, Boeing, like Lockheed Martin. Those are all sort of in that type of aerospace defense kind of group. all charts that are holding up pretty well, and many of those in fact actually improving today, actually up today on a down day. The outlier has certainly been the energy sector, by far up and to the right, showing renewed strength. Overall, it's heading sort of southeast, which is not ideal, but overall still performing very, very well relative to other asset classes on that weekly time frame, which is sort of that intermediate time frame for all intents and purposes. Let's finish off this segment here looking at the sector ETFs using the candle glance function. So this is where we can take a chart list, in this case, the 11 S&P sectors and the S&P 500, put all their charts up at once. And this is one of my favorite ways to really look for relationships. Which charts look similar? Which charts look different? Which charts are breaking out? Which ones are breaking down? It is literally a visual scanning tool to recognize shifts, recognize inflection points. So what looks strong in this group? And what I mean is charts that are breaking out recently, stocks that are above moving averages, ideally upward sloping moving averages. That would be sort of the sweet spot of bullishness. Not many of those. As a matter of fact, only 2 of these, maybe 3 of these as I'm glancing around, are up above 2 upward sloping moving averages. The most classic one would be the energy sector. Now, energy stalled a little bit. The XLE got up to 95, sold off quite a bit today. Energy was the worst sector, down 3%, but still above its 50-day moving average. You also note healthcare is actually above both the 50 and 200-day moving averages. The 50-day just starting to cross above the 200-day, which is called a golden cross. I rarely say that on the show because, to be honest, I've not found that to be a particularly effective signal. It's an interesting comment. It's an interesting thing to throw around. But, in general, are you good buying golden crosses and selling death crosses? Not really. And you can see that from June of 2022. Which is the last time we had a death cross, which was literally the bottom. The problem is it's such a lagging indicator. It's not a great way of smoothing out price action for any sort of trend following technique, which is why my market trend model and other quantitative models that I would use that focus on moving averages, use exponential moving averages, just a better way to smooth out the price data. The third one that actually fits that criteria, above 2 upward sloping moving averages. We talked about energy. We talked about healthcare. I think technically staples would fit that as well, with the 200 and the 50-day both sloping higher. Now, what's interesting is healthcare is really the only one that's continuing to be in a decent phase. A lot of these are either hitting their 200-day and stalling, or they're not quite above those moving averages. Let's look at a chart of the healthcare sector. You can see the XLV is actually testing a multi-year high here, right? It's back up to the high from December of last year, the high from April of this year. The relative strength for the last 12 months, not bad. And this is in a sector that a lot of people, I feel like, have kind of written off at times because there's a lot of mixed results in it, right? So you have pharma, you have biotech, you have supplies, equipment, all sort of different groups with different patterns. But overall, the XLV managing to put out some strong relative returns. We're going to take a brief break here. When we get back to my next segment, Shifting Stocks, we'll talk about a couple of healthcare names, as well as others in industrials and technology. We'll see you in a minute. Hey everyone, welcome back to the Final Bar. This is Dave Keller here at StockCharts.com. Thank you so much for joining us every weekday after the close as we break down the activity in the markets using stock charts. A couple quick announcements before we get to my next segment. First off, we welcome your questions. We had a great mailbag segment on Friday's show. We'll do another one on tomorrow's show on Tuesday. We'd love to feature one of your questions live on the air. Our email is thefinalbar@stockcharts.com. We are on Twitter @FinalBarSCTV. And we're on YouTube. Put a comment below the video you're watching on our Stock Charts YouTube channel. We'll gather all those questions and hope to answer one of yours live on the air on Tuesday's show. Also, go to StockChartsTV.com. That is our on-demand platform. We have so much great content every trading day, highlighting some observations on this uncertain market environment. As we get to year end, we're going to have a lot of year end special programming, setting up for a market outlook special coming up in January. All of that info is available for free at StockChartsTV.com or on your mobile device. Just search for Stock Charts TV on demand. Let's continue on today's show with our next segment. We started big picture with the macro environment. We talked sectors and the rotations, and now we'll talk about the third piece of that puzzle, which is the shifting stocks segment. Let's talk about some individual names. Before the break, we were looking at this chart, the XLV. We're talking about how the XLV is testing, multi-year highs, and the relative strength has been really impressive in the sector. Now, why is the sector doing so well? I would argue it's charts like Merck, right? Merck MRK is a good example of strength in healthcare. Now, this is not, not all healthcare charts look exactly like this. But if you look at Pfizer, Merck, some of the pharmaceutical names, they've had some really strong runs. Even in biotech, you're having some charts that look similar in terms of their renewed strength. And a lot of these had good runs earlier in the year. Merck in particular was sort of sideways choppy. And then look how it resolved out of that basing pattern to the upside. This is why we talk about basing patterns quite a bit. A basing pattern is where you have a rally. It's sort of a consolidation phase. Think of a basing pattern as kind of an equilibrium, right? We all sort of come to an agreement that Merck is worth about $88 to $90 a share. That's kind of the midpoint of this range. And then what's happening is we're just sort of fluctuating above and below that kind of ideal value for Merck. Then something changes. And when we set a base, set a rectangle, and then we break out of that pattern, that tells you something's different, right? What I call a change of character in the chart. Something new, there's new information, there are new catalysts, there's a new influx of buyers, there's an evaporation of selling pressure, whatever it is, whatever combination of those things is causing the price to go higher. And that is why we focus on stocks breaking out of bases as one of the patterns we want to pay attention to. So Merck is an example of why that sector is kind of doing pretty well. A couple charts to highlight within this sector that I caught as I was doing a review over the weekend. CVS is kind of an interesting one, right? If you look, CVS actually sold off to make a double bottom pattern. This is pretty common with equities in 2022. We had a June low, kind of a summer low, and then we had a fall low as well, right? So we had the June low around 87.50. We have the October low here around 86.50. And from there, we've now rallied. Now we're hitting resistance. And look how we tested support. We're not breaking higher, we're testing resistance. It almost looks like a head and shoulders kind of pattern. It's not an ideal one, but kind of like that. And with that type of pattern, as long as you get above the neckline, which is right here, right around 102.50, that indicates much further upside potential. Now, the challenge for this chart is you're selling or you'd be rallying right into resistance, right? The all-time high here is around 108, but it certainly would suggest an up move to there if we can get above 102.50, get above these resistance levels here from the last couple months. Also highlight Johnny John JNJ. If you look at, they had a high here in April, kind of unusual. A lot of stocks topped out sort of end of last year, maybe in January, and then energy stocks kind of topped out later, maybe in June. Johnson & Johnson is one of those weird ones that actually had a top in the spring, actually had a top in April, and then kind of sold off from there. Look at how we've now round tripped back up to those highs, right? And so again, the all-time high here is around 180, 182, just literally just above current levels. So this is encouraging, in my opinion, that you've had a stock that is round trip from going, losing, 20, 30 points and then sort of rallying back and testing all-time highs. But the other side of this is significant overhead resistance, right? What would it take to put Johnson & Johnson above the previous high, above 182? That would require sort of additional demand, additional accumulation, additional investors wanting to pay more and more. And my concern is, do you see that happening if the markets overall start to struggle? Left to be seen, but that's one of those charts I would put an alert to see if it's able to get above those highs. That could be a real sign of something good happening. Now, I mentioned the industrial sector. I'll highlight a couple of these. Boeing actually showed up on a scan I was running earlier today, just looking for 3-month highs and lows, just sort of thinking about what names were moving as we went through the session today. BA came up on the list. Nice break above the August high. So August highs are on 170. We broke above that. That became support here in the last couple weeks, and now we've sort of resolved that to the upside. Friday was a nice pattern, closing above 180 for the first time since April. Now we're actually continuing higher. So you have a nice follow through today. I think that's a good chart with a decent setup. I think that's one that is worth looking at. The second one would be RTX. This is in that same sort of aerospace defense group. Kind of similar to Johnson & Johnson in that you're rallying up to previous resistance. So my question for this is, can we get above 104, right? Can we make a new high? And while it sometimes can be a challenge to buy new highs, and I know that, sometimes you feel like you want to buy it back down here, but remember, the whole point of trend following is you're waiting for a trend to emerge. And I would argue that the trend in Raytheon is at best a consolidation on the longer time frame until you can get to a new high. That confirms that this is a breakout. It confirms that there's enough momentum to push above that previous level of resistance. We've not seen that quite yet. I would also put LMT, Lockheed Martin, in there, again, making a new 52-week high on Friday, getting up to $500 a share. Pull back a little bit today, about 1%. What concerns me about this particular chart is a bearish momentum divergence. And, I've often told people, I think your goals as a trend follower, as an equity investor, should be threefold. Number one, identify trends. Number two, follow those trends. And number three, identify or anticipate when those trends may be exhausted. And that gets into sort of the leading indicator part of the technical toolkit. And I think momentum divergences are a great way. I mentioned a bullish momentum divergence of the S&P off of the lows in October. This is the opposite. This is a bearish momentum divergence where you see the highs in November, higher price highs at the end of November, beginning of December. But look how the RSI was overbought on the first push higher, but not overbought the second time. So higher highs, lower momentum. That could be a warning sign that we're actually hitting an exhaustion point. What's good about the chart like this, 460 was the resistance here, 460 now support. That's a really clear level of support. If I use the inspect here, you can see that sort of horizontal line right around 460. Could be a really good place to place a stop, really good place to anticipate potential support if the market would sell off from there. Finally, just want to mention some of the airlines, a number of them in the top gainers list today. This is AAL, this is Delta, this is United Airlines. All three of those sort of trading higher during the course of the day at some point today. UAL is maybe one to highlight here, potentially coming out of a pennant pattern, but I think we'll need to see a little more follow through to the upside. Sort of a weird chart, right? I mean, it didn't go anywhere on an absolute basis for about a year and a half, right? Noisy and choppy, but really just a horizontal line sort of takes you through the entire price action here. But look what's happened recently, right? We rallied from 32 up to about 42, then stabilized around 44, narrowing of the range, and now resolving to the upside. I'd like to see if we could get some more follow through and push above those previous highs. A lot of overhead resistance, though, which is why airlines in general haven't been great charts. They just haven't charted particularly well. But again, I'm interested in things that are working, and that's why that chart could be of interest. We need to wrap the show and go to the 3 and 3. Let's hit on 3 charts in 3 minutes that tell the story of this market environment. And here is chart number 1. We talked about the macro environment, and I didn't get to talk about currencies and commodities too much. I did highlight the chart of gold. This is a chart I was looking at over the weekend. I just want to share with you. It's sort of the weak, the okay, and the strong, right? Sort of bad, neutral, and bullish, right? I guess is how I would describe it. The dollar index making a lower high in October and breaking down, getting below 106 was meaningful, I think, on the dollar index. Rallied today, right, as risk assets were selling off. But overall, I think the trend here for now has been lower. If that reverses, that is something that could absolutely kill the normal seasonal strength in equities in December and really maybe be more foreshadowing of challenges in the first quarter of next year. Crude oil, by the way, has been essentially sideways, although testing support, if not breaking down around $75 a barrel. And then you can see gold actually rotating to the upside. So you have weaker chart, a stable chart, and then a rallying chart. Again, bit of a mean reversion today from those trends, but that's the longer term time frame that I've been paying attention to. I highlighted the industrial sector. This is a different chart. This is one that I use in my monthly chart review for my Market Misbehavior Premium members. I actually did a monthly chart review last week. This is one of the charts we spent some time on. This top series is the relative strength of industrials versus the S&P. Then this is the weekly price data, and then the weekly momentum at the bottom. Just look at how the relative strength has improved over the last 12 months. I like sectors that are showing improving relative strength, right? Stocks with improving relative strength or ETFs are the ones that are going to help you outperform a passive investment product like the S&P, the SPOOs or the Qs or any of those sorts of things. So looking at strength over the last 12 months is what is characteristic of the chart of industrials, also healthcare, two of those sectors where we broke down some of the individual names through the course of the show today. Finally, I mentioned in our segment Shifting Stocks some of the names on the move, particularly in the healthcare and industrial sector. LMT might be one of those. We highlighted a bearish momentum divergence recently in Netflix. Overall, still holding up okay, but I think suggests to be a little bit cautious. And anytime the market is testing a new resistance level, testing new swing highs, but you start to see bearish divergences, that a lot of times is a bit of a red warning flag telling you that all might not be well. When I'm looking at LMT again, I think there's a lot to like in the industrial sector, and I like particularly aerospace and defense, which charts have held up very, very well. I think there's good obvious support on these charts, but I'm concerned about the bearish momentum divergence. Watch to see if we break down from here. Folks, that's a wrap for the show. Thanks for joining us. here on a Monday afternoon. All of our previous interviews and episodes can be found at StockChartsTV.com. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Be safe. Have a great night. Hey guys, Dave Keller here with StockCharts.com. Thanks so much for watching our video. If you enjoyed it, and we hope you did, hit the like button right below. Also, we have so much new content every day. Consider subscribing to the channel. Just hit the subscribe button in the video or right below. Thanks for watching. Stay safe. Have a fantastic day.